There are concerns around the investment grade market. Data Track has been pointing out overnight that the New York Fed's corporate bond market distress index shows investment grade corporates seeing 2011 style market stress. They say even while the high yield market is operating fairly normally, which is kind of not a great indicator for the bond market. Do you need to be concerned about some volatility, some distress in investment grade?
Well, I think volatility, undoubtedly, we've seen it. I think it's going to continue because we're walking this wobbly bridge from one side of the canyon to the other, from zero interest rate policy up to neutral or restrictive. And we've got Vladimir Putin at one end of the rope bridge, wiggling it around, trying to get us to fall off. So, yeah, distress, definitely. But, of course, markets price that in. Now, in investment grade in the US, we've been well aware for a long time that the composition of that universe has deteriorated in terms of credit risk because you had a lot of issuance at the lowest rungs of investment grade. So you've got a great big bulge there. And that creates an issue which is particular to the US. It's not reflected actually in UK and European investment grade universe in the same way.
Chris, sorry to cut you short on that answer to Karen. Just moving on slightly, are we being myopic and stunningly short-sighted by your initial comment, and I appreciate it's the market saying it, not you, that bad news is good news in terms of where the direction of travel goes for long investors? Bad news means potentially we are going into a horrible scenario where a recession, possibly a cost of living crisis, almost certainly a cost of living crisis, plus inflation. When you're looking top down, I see why the market wants to make these broad sweeping moves, but bottom up, it's pain across the board for all companies in those scenarios. Yeah,
absolutely. And, it's all a matter of taking the right fences at the right time, isn't it? We're trying to look no more than 6, maybe 12 months in advance right now with all these variables, your time windows shorten. And the bad news is good news. It's all about policy. And that's why bad news is good news, because people look at the bad news and say, OK, this means we've got restrictive monetary policy and they're going to come off the acceleration, they're going to moderate. And that's very much what's going on now. Everyone's horrified by what's going on with lots of things in the world. But terrifying investors is this where interest rates are going to land. So that's why bad news is good news. But and I think could still drive a decent rally against a backdrop of very negative sentiment through to the end of this year. Next year's problem is going to be, have they already done too much? Have they over-egged the pudding? Can we get away with this mild recession, or is that wishful thinking? Are we going to get a double dip as the recessionary forces have already been unleashed and they ripple through employment conditions? All these things, absolutely. And sometimes in markets, you get a bad news is good news and then a revival and a recovery and we break through. Other times you get a double dip. So we'll be on the lookout for that. But I think that's more of a next year issue, actually, from this point than a 2022 issue.